Okay, good afternoon, everyone. On a Friday afternoon, as we bring June to a close, June 26th, today we're going to be looking beyond the payroll protection program and talk about leveraging COVID to strengthen cash. And our guest today is Brett Ellen. We'll go into a little bit more detail on Brett here in a few minutes. But first, I want to give a little bit of background and context here. So if we look at the business expenses in a business, next slide, please, Michaela. If we look at the expenses in a business, the top 5 recurring expenses, the first 2 are usually pretty set, labor and taxation. And then the next 3 most commonly are the management and the development and the delivery of the product lifecycle, technology within the corporation, both the development as well as use for infrastructure, and then third in the area of facilities. And so today we're going to be focusing on the taxation part with our guest, Brett. Next slide, please. And so what I'd like to do is first just do a brief reflective exercise. So I'd like everyone to take out a pen or a pencil and a piece of paper and just answer these questions for your own business. So the context is, as a business owner, first of all, on a 0 to 10, being 0, I don't do this at all, 10 being I do it regularly. In my own business, the business that you own, do I proactively use tax laws to benefit the company, our investors, and our leadership team and employees? Let me give you 10 seconds to reflect upon that and give yourself a score. And then we'll go on to the second part. Okay, part 2, we've looked at the business. Now think in terms of your own personal individual life. Question 2 on a 0 to 10 scale. In my personal life as an individual, I proactively use tax laws to benefit the generations within my family, your generation, as well as the generation coming up behind you or generations coming up behind you. Take a few seconds and give yourself a 0 to 10 score. Okay, all great tax strategies deal with both the corporation as well as the individual. Now, in mid-March, North America and the world began to shut down for COVID. And as a result of that, it's put great stress on businesses as well as families, as well as created opportunities. And so I'm calling this Blindsight 2020. It's the year of COVID. And so as we pass through the halftime mark of the year, from June to July, I would like to have you just reflect a moment as you look out through the end of the year based on your trajectory and your expectations. Will your business in the year with a positive net profit, or will it be a year of loss? So just think about that for a moment. Close your eyes if you need to and reflect on what the year will look like. And so as you think about that, your strategies for both corporate and income taxation to increase cash flow, to retain more of what you've created in your business, either individually or in the business, will be directly dictated or connected to whether you're going to have a net loss or net gain this year. And there are different strategies. And so next slide, please. So at this point, as we step into the context of, are you using tax strategies for your benefit and your corporate and your personal benefit, and what type of year will you end with? I would like to introduce Brett Ellen. Brett has been with us before. He is the founder of American Financial Network, as well as the alliances around, we call them centers of influence around AFN. Brett is a 35-year professional within the financial planning industry, and he is just a fantastic philanthropist and a strategic partner in our world. Brett, with that, let me hand it over to you and take us through our webinar today. And every now and then, I may interrupt, just ask a few questions. And Brett, I'll keep an eye on chat too if someone has a question.
Thanks, Keith. And I think that picture with that tie was the last time I wore a tie. So I have to remember that when I start my meetings. So very appreciative. Just to start off, I know it's been challenging times to step 1 week back. I hope those who are parents had a wonderful Father's Day, and probably I'm still glowing a little bit from mine this last week. So hopefully you guys had a chance to enjoy the way we did. Want to just give just a quick overview of the process as we view things from the American financial network world in dealing with business owners, public, private companies, whatever the case would be. We do like to ask 8 questions, and today we're focusing on one of the questions, which is that the CEOs have asked us, which is how do I reduce my taxes? It's been significantly important. Obviously, many things maneuver around tax. Matter of fact, I will personally tell you that we are moving this next week over to Las Vegas from California, just to give some of that example. So you can go to the next slide, please. So the idea that we have together in unison with Gravitas and the other centers of influence groups is that in most cases, to have the success hopefully you're having or have had or will be having moving forward, that is based on having a well functioning at the highest level execution team to help look at the goals and the objectives that are set and go out there and do the things that Gravitas coaches to get your company to that next level. But at the same time, the outside professionals need to be as aligned, because most times they're siloed, and to have a world-class team around you and inside your firm and around your family, and within your family is really the key to success, as you can see here in this diagram. Next slide, please. This is a very busy slide. I'm certain that we can get the presentation out to everybody who'd like it. I know it's being recorded and for others to be able to enjoy, but you will see that many pieces of this pie graph will be discussed today. The objective I think we have as a group is we're going to go through 3 sessions. Today's session is more of an overview to understand the fact that we are focused on both the business and the people in the business. Especially my talent and our team's talent has been more around the executive team and the ownership structure. And so the focus is, if you truly are trying to help accelerate to meet whatever the goals and objectives are of the family and both the business side by side, that they do sit side by side. And typically the path is to navigate all the smartest tax ideas at the company level first. And then once you've completed and exhausted all those, move those then down to the family at the time, whether you're a C Corp, S Corp, LLC, however it plays out, to understand that there are 2 opportunities here to do some significant planning. And I think you'll see by the time we finish this discussion, a case study that will make this come to life. Next slide, please. So many people have heard different things about how to characterize money. Money is a beautiful thing for most of us that enjoy it. I think there are 2 types of money. There's pretty money and ugly money. And if you understand pretty and ugly money, this discussion will go better. When you think about ugly money for a second, there's no such thing as ugly money, to be honest. All money is good money usually, as long as there's something behind it. But when I talk about ugly money, when you have earned income and it's all taxed at the highest level, you're sitting here talking about just over a 37% tax here in the United States federally, and here in California, additional 13%. To know that 50 cents of every dollar you're making is going away is challenging. Then you start thinking about other forms of money. If you get a capital gain rates are 20%, right? And then depending on the state, and if it's a gain, certain kinds of gains, there will be an Obama tax on top of it. So just in federal, 20% is better than 37. And if, for example, you made your money and you happen to hold it inside of something that is tax-free and there was 0 tax, that would be the prettiest. So you can go pretty on one side, ugly on the other, and there's a bunch in between. The objective of this exercise is to try to make this money as pretty as possible and try to have the net results be as positive as possible. So the first part of this in discussion to Keith's opening, which is in the event that this is a tough year for you, either a very low income year or a potential loss year, that is as much of an opportunity in planning as a great year is. And so it's important that you think about what are some of the things I should be thinking about if it's been a challenging year. And I can go through 1,000 case studies, but today is more an overview day. We'll end with a case study, but I will just touch on these different pieces to get you guys thinking about it and gals thinking about it. But I think it's important. So if we had a tough year, then most times, most others have had tough years. And what an opportunity to acquire other companies or things that were necessary at a price point better than probably you've ever been able to be at least in your recent business years. I think implementing strategies to grow the business, so pick up market share, is also an opportunity, as some will disappear. Certainly many are challenged. And as much as the government's tried to support it, it's been more, of a Band-Aid as opposed to, something that's really had as much of an impact as most of us would probably want or need. Strategize to reduce expenses. In times like this, you kind of pull back. Are there ways to reduce my insurance costs? Are there ways to reduce payroll? Are there ways to reduce any form of costs that are out there? This is one of those times where it makes sense. Evaluate opportunities to maneuver estate plans. This is probably the most important of all of these different ideas here when you've had a tough time, knowing that this is something that has happened because the world has changed, not necessarily your business in some cases. If that being the case, evaluate your company at a lower valuation and being able to do smart tax creative strategies, like maybe you're going to do some selling of your business or gifting to your family. So for succession plans, it makes sense. If you're at a point where you're trying to lock down key executives and you're looking to lower the valuation for any kind of phantom stock or direct ownership, this is a great time to do that. So there's a lot of time right now where this is a golden opportunity that many miss. They're so busy trying to get the business back on its feet or turn it around that they're missing those great strategy opportunities here along the way. Strategize the use of your losses, if you have some, in the most meaningful way. So as the losses flow through, what are some of the things you can do? You could convert your retirement plans, IRAs, to Roth. I have a client today that's got over $30 million in a Roth now. Was able to convert the $3 million 6 or 7 years ago from a traditional ordinary income position, which is really ugly when you're retired, into a place where that money would be tax-free for their lifetime and will go to the beneficiaries tax-free. It's a big one. You could maneuver capital gains in a year like this. You could do 401k Roth contributions as opposed to traditional contributions. And there's many, many others, but for today, these are just some of the things you should be thinking about. Next slide, please. In the event that you've had a good year or a great year, from our family office perspective, and we have a family office as well, the majority of all the businesses we've invested in are having banner years. And so the tax planning around this is part of the reason for my own personal move, as well as our family. But there's a lot to be said in this. But when you think about solutions, let's look at the business first. And there are probably 30 solutions to this. We've just listed 5 for timing to go through this and be efficient with our time and just give you guys and gals some pieces of this that you should be thinking about. Qualified retirement plans are usually where we start, right? And most people think about qualified retirement plans as being 401k plans, sometimes profit sharing. I will tell you that this is an amazingly underserved area. There has not been a single retirement plan that I've seen in my history that I've not been able to improve. So whether you're whether you're setting up defined benefits or profit sharing, there's cash balance plans, there's carve out plans. There are a ton of ways to take advantage of the qualified plan arena. Some that are for smaller companies that are focused more on the owner. For larger companies, certainly more focused on all the employees. And then if you were to go to the next level, which is executive non-qualified retirement plans, these are plans that are non-qualified, meaning they are for the senior team, for the executive team, very rarely, by the way, for the owners. So when you think about tiering and how you think about your people and the best way to get them to hit and surpass the goals you set for them, a lot of times these plans have a big impact. This is a really good time to be setting them up. It is by far the busiest we've been in our history in this space right now as we speak. So it's a very hot area right now. But from a deduction perspective for the business, you cannot deduct when somebody defers in deferred comp, but the company contributions you make toward these plans, like performance unit plans where you're only making contributions if we've hit certain successes, those kinds of plans are deductible, right? Risk management. From a risk management perspective, we have a world-class team of insurance groups that will review and look at the insurances that are in place to see if there's ways to reduce it. But many times, and from most of the companies we represent, the creation of their own insurance company has a significant impact. And there's benefits both from insurance reduction to insurance management to as well as some tax benefits and estate planning benefits that tie in there. And I will tell you that each one of these 5 categories could be an hour by themselves. So I'm just trying to give you a little taste for this call, but these are important and good places to start. R&D credits, cost segregation, Section 179 deductions, and other forms of credits are a really big deal right now. And the IRS has come out and allowing you now that if you have these kinds of benefits or have losses, carrying back some years, and it's really almost to a point of being unlimited, but carrying back years to get capital back in place right now is one of the smartest strategies for 2020. So definitely make sure that if you've not looked at the R&D credits here in California, they have new hiring credits that they give to bring executives into California, significant benefits. Those who've had great years, we represent a lot of firms that actually sell airplanes fully deductible. You could buy a $10 million airplane and save $5 million in tax this year. So there's unique things that go on in and around that space. That's a cool space. And then entity structure, because of the flow throughs, because of C Corp versus S Corp and LLC, a lot of times when you have a down year, there's ways to restructure without having much of a tax impact. Next slide, please.
Hey, Brett, before we go on, on the back one slide, please, Michaela, talk a little bit about, we have international guests on today too. And this is primarily, we're talking about the United States, but also comment perhaps on international also.
Yes, great. Thank you for doing that. And I think that was one of the comments I meant to make when we first started this. Every jurisdiction, and even in, obviously different states have different issues here in the US as well, but outside the United States, there's so many different rules and regulations around this. Some pieces of this actually flow through most countries. Some of the things around the insurance space pretty much can be done in most places. Usually the compensation plans can be directed in ways that make sense. Usually the qualified plans are very different. So those are, as well as some of the tax credits. But we're talking with a lot of politicians right now in Latin America, and some of the things we're bringing there, they're actually creating tax benefits for what we're bringing. So there are very unique ways to review and look at this, but the suggestion would be that we would, when we're doing a diagnostic, we'd want to understand where the opportunity is, and then make sure that we put the right team around us to be able to give the proper guidance here. I think the philosophy of still being tax efficient and tax smart doesn't change, but the navigation to get there, of course, is a little different. And
Brett, you have access to relationships on the ground in other countries worldwide that you can draw upon to do that, correct?
We do.
Okay, thank you.
Thanks, Steve. Sure. On the personal side, so for today's purposes, we'll focus more on flow through, since most entities today are flow throughs, and all public companies, all insurance companies are C Corps, but for the most part, what we see is probably 80% of the companies that we engage with have some form of a flow through when they're not, assuming they're not public. We've gone out there, we've looked at all these different ideas through the business. And again, in the business, many times the business is could be owned by private equity. It could be owned, you could have different investors in place. So a lot of times who and what we're trying to accomplish has a different impact. Sorry, there's some noise here. Sorry about that. And in some cases, like I've got a good friend of mine that manages a significant amount of the athletes here in the United States. He actually works for the firm. He's the director of the wealth management for that firm, but he's not the owner. The owner happens to be a large agency. And so because of that, he has to play at this as the executive as opposed to the owner. So when you think of this piece, for those that you represent that are non-owners but are executives, this is kind of a look at that as well. So either flow through to the owner or directly start the project from the executive's position. And we all know we're only as good as our people. So, the ability to make sure those people have the same kinds of opportunities as we do, and that you can put them pari passu next to you in some of the planning is pretty interesting. So now we move back to qualified plans again, but this time, instead of being the company that is arranging them and setting them up, now we're actually talking about making contributions. So when I fund my 401k plan, if I'm able to, if the firm allows for it, I would love to defer my compensation. And a lot of times, again, good years, deferred comp can be a big deal. For those who've had deferred compensation in the past, if this is a rough year, maybe this is a great year to have the distributions come out at a lower tax bracket that you've been deferring for a while. So the movement around that. Do I have money in my 401k right now? Do I do it as a Roth 401k? And does the plan even allow that? And right now, 92% of all the plans in the United States right now do not have Roth 401k features to them. We would have thought we'd be way farther ahead of that. So you can actually do your whole contribution for 401k to Roth. In a low income year, do the Roth. In a high income year, probably traditional makes more sense. And you can also convert from 401k traditional to 401k Roth. And again, if you've had a loss this year, that normal tax event would not hurt you this year. Be a great opportunity. Opportunity zones. I have done over 30 panelist speeches on opportunity zones. I would put myself up there as someone who knows a lot. The word expert is a tough word, so somewhere really close to that line. Just quickly overview this because I think it is important today to get that. If there are two different issues, if you are starting a business, okay, or if you've had a capital gain, but let's just talk about capital gains. These capital gains can be ordinary income if they are short-term, and they could be capital gain income if they're over 12 months. In the US today, you have opportunities of two kinds of opportunity zone gains. One that is passive. If so, this year, if I had a gain on a stock as an example, or a piece of real estate right now, I would have until December 31st plus 6 months to be able to choose to defer the tax on that all the way until the end of 2026. That's one of the coolest. This tax law is supposed to have an impact of around $7 trillion to the U.S. government. That's how big this is. The biggest tax planning platform of all time. If it is a sale of an active business, you'll have 6 months from the time the asset closed, the sale closes. So the sale closes during that time, and you have opportunities to go out there and look at two kinds of investments, either real estate investments or businesses that you can invest in that qualify. There's 8,700 or so different opportunity zones in the U.S., including pretty much all of Hawaii, Guam, Puerto Rico, that plays into this. And California is one of the few states that has not gone ahead and completed their choice or decision to honor opportunity zones. So in California, you cannot defer the tax, but in most states you can, federally, all states. So you're able to defer till 2026. At that time, you'll pay taxes at that tax rate, but you'll have a deferral. So if it was a $10 million sale, that would require here in California $37 million. We won't go California. We'll go Texas for now. So on that 24% tax, the 20% capital gain, and the 4% Obama tax, actually 3.81, you have the deferral until that time. And let's say it stays at that tax rate. At the end of 26, you'll pay your $2.4 million in taxes. However, if you invest that in one of these opportunity zones and the value of the opportunity zone fund went from 10 million to 30 million, if you held it 10 years or longer, the difference between the 10 million and 30 million would be subject to no tax ever. Right. So from the business perspective, I was on a call with one of my good friends from Baker McKenzie yesterday. And for the first time, and I've been on this for almost a year, for the first time, you're starting to see groups now starting to look at the business side, which is way more opportunistic than the other. So opportunity zones are a really big deal. And so you make sure if Keith ever needed me to, I am more than happy to have a full discussion just on that. It's a very unique space, but very, very valuable. We will probably do about $1 billion of opportunity zone movement for our network this year. Real estate related deductions. This is another big one. If you own your buildings, the building you're in for business, or if you own multifamily properties, you can accelerate your deductions by doing cost segregation. We have saved our clients hundreds of millions of dollars in this space. And to me, it's free money if you do it right. And so a lot of times there's not good groups doing the diagnostic. A lot of people believe their CPAs will just do it. There's groups that are world's best in class in doing this. It's a pretty big opportunity and issue. You have new markets credits that flow near opportunity zones or within them. And you have low-income housing credits that you should also look at, as well as solar credits. And for those who don't know the difference between deductions and credits, if I had a $10,000 deduction in a 40% tax bracket, right, I would save $4,000 in taxes. If I had a $10,000 credit, I would save $10,000 in taxes. Tax credits are ideal, really important and valuable. Next one, and this is one that for those who are having good years, hopefully you come away with this one for sure, because some of these other ones you might have been hearing about, reading about, maybe you've done some. This other area right now is an exciting area. It's been one we've been involved with for 25 years as well. And investing in favorable tax treatment type investments. So we mentioned Roth before. That's more of how you hold something. Now we're talking about the actual classes of investing. So you can invest to get solar credits, which is in in item number 3. You can invest in low-income housing investments that do that as well, or you can actually create them yourself. In the oil and gas space and the conservation easement space, these are very interesting spaces. We'll start with conservation easement, and you'll see it in the case study we do here in a minute. But the law says that if you're going to protect land to perpetuity, this is land that will stay forever. And most people, when they think about this, they think about the spotted owl or some area where they know they can't build because of water rights. They get that, but that's way more prevalent than you think. In 2019, there were over 18,000 conservation easements done in the United States. There were only a handful of ones that were done in a way where you could join forces with others. And you could do it either way. But the facts are, you could take up to 60% of your adjusted gross income, 60, and deduct it for purposes of conservation easement. So, and I'll go back and use this in the case study so you guys understand it clearly. And so typically we look at these first three ideas. Once we've done all those, we look at the easement. If my taxable income now is X, I'm going to look to go 60% less than that. So the key here is that the majority of your advisory groups, the kind of return you can make just by doing that is significant. Then once I've got that number down to that 40% of what my taxable income was, I can do oil and gas on top of that for an additional up to 40% of my AGI. And in today's environment, there are some unbelievable opportunities in oil and gas as it's hit so low. And the opportunity that's there is really, for me, there's an economic reason way more. And there should always be economics tied before you, when it comes to investing, I think the economics have to, wag the tail of the dog. So, but just know that this is an important factor. I spent a little more time on that, but that one is very active. Literally, probably 20% of my time from August 31st from September 1st to the end of the year is on this exact subject. And the last is charitable giving, which can include, and by the way, conservation easement falls under non-cash charitable contributions. So it would be on that same list, but charitable lead trusts, which are ways to navigate when you have high income, ability to shelter some of that income every year. Charitable remainder trusts, which are more about, I'm going to sell something and I don't want to pay tax ever. Private foundations, which my wife runs ours. Our foundation is called Turn Kindness On. So you can create your own, or you can look at things like donor advised funds. Next slide, please. As we get ready for the case study here, just kind of talk you through the process really quickly. The idea is to do a diagnostic. Others call it an MRI, some of it financial MRI. Others, we've used all kind of feasibility study, but we want to truly understand all fact patterns and all the things that are important. And this is what I was saying earlier when we looked at some of the graphs that we started off with, which is this is not a subject matter that any one group should be focused on. It should be a collaboration of all of your professionals. If they're not doing it this way now, get them to do it. Just think about you being in the center of the pie, right? And everyone else out there working together, streamlined to figure out what our needs are. Many, many times, some of the best ideas come out of someone in a different category. So it's just that collaboration that makes a lot of sense. So number one, we do a diagnostic, determine fact patterns, and most importantly, what your goals are. So one of my favorite things to say from Alice in Wonderland, if you don't know where you're going, all roads will get you there. So we want to have a good, a design game plan to try to find our way there. I also believe to get there and have the world's best around next to you and beside you is important as well. Okay, do that, get engaged to get the team engaged, working together through the deep diagnostic, make sure we follow it, make sure we're on the same page, the team's on the same page, and get to implementation and execution, and then have an ongoing review or scorecard to make sure that we are not just hitting those, but actually getting in front of those. And I can tell you, working with Gravitas, I know how focused that team is in that discussion. So what I want to do is kind of go over with you this fact pattern. I want to spend the majority of my time. So I went through those slides relatively quickly, not because I always talk fast, which this is probably pretty good for me, the pace I'm going right now, but more importantly, because it comes to life more in the case study, and because we will do a more detailed discussion on the next opportunity we have here, we can get into that deeper. So I'll just give you the fact pattern. This particular client came to us about 10 or 11 years ago, had done really well. He was looking to join the YPO chapter out here in Southern California. But they had found out that he was thinking about moving, so they decided not to actually have him join the YPO group. But when he was making so much money, he was just frustrated. And every one of the members of a couple of groups here of YPO are clients of mine, and said, "You talk to Brett because you're just killing it, and Brett can help you." So at the time, company today is an LLC still, 70% owned by the founder. One of the smartest people I've met in my life from an investment perspective, believe it or not, invested $30,000 to get 30% of this company. When you see the numbers here, you'll understand how smart of an investment that was for him. Last year, the company did $85 million of revenue, and these are rounded, with $30 million of EBITDA, 120 employees, 15 of them highly compensated. Founder lived at the time we met in California, then was in Nevada. We couldn't really provide that he was there enough, and now is in Miami. CEO lives in Boston. We met them. They were running around $30 million of revenue with $10 million of EBITDA. the existing tools that they had at the time for tax planning purposes. And remember, we're focused there. We did way more than what you're seeing here, but this is just the tax side of it. They had a simple IRA. At the time, the employees could only put $6,000 per year into that plan, deductible, very simple. They had no long-term incentive plan, but were considering maneuvering some stock to those key 15 people. They had just the minimal amount of health insurance in place. As a note underneath this, at the time of hire, the founder was in a 53% top bracket. The CEO was in a 48% tax bracket and had paid $5 million in taxes between the two of them in that year of the $10 million profit year. The goals, they just were literally crazy. And it was funny. I got on the call with, the guy's name is Seth. I got on the phone call with Seth the first time he was introduced. I shared a few ideas. He told me if I could reduce his taxes in half, I could have everything. Now, I've never really understood what that meant. I could have everything. I don't know if he was trying to send his company to me and sign it over. I did know what it meant after spending these 10 years and becoming a very close friend of mine. What he really meant was all the services. We built his family office. They're crushing it right now. We think we'll have over $1 billion sale in the next 2 years. But it was very eye-opening for him to have this look. So taxes was important, enjoying life, and he wanted to be invested in at least 50 companies and start and play that role. So those were things he was excited about. Next slide, please. From an engagement, process, obviously the first thing that happened was we came in this relationship. We chose not to go to the individual planning route. He wanted to bring us in to both work through the business as well as him, his partner, and the other 15 executives. Hired all of them to build this thing out. And you'll see as we build this out why it was important to include the executives in this, not mandatory. It was his choice. And we became the corporate and executive advisor initially before we built the family office. Okay, it's going to get a little bit noisy in here, so my apologies. You'll see some summary of this, but just try to stay with this because it's a lot. In the planning for it, we created a 401k plan for all the employees. It is my opinion 401k plans are for employees. They don't normally mean as much to the owners from their own personal needs. It's really there to be able to make sure they've got a happy team, and we do historically suggest a match, and so there's a lot that goes into that. We created a profit sharing plan, 2 different profit sharing plans actually. That was focused on the executive and the owner and the executives, but we excluded all of the sales team from the 401k as well as the executives from the 401k plan. And if you understand non-qualified plans, you can only offer non-qualified plans to a handful of groups. If you understand qualified plans, if the highly compensated employees want to put a lot in and the lower compensated employees want to put a little in, which is pretty historic and pretty normal, then there's always testing problems, which creates a problem for the company. If you carve out all of the highly compensated people, you don't have problems in your 401k plan, right? If you can do it in the right way. So we basically, just to give you some on the 15 people executives, we are putting $55,000 per year profit sharing dollars. And initially when they set it up, they adjusted compensation for this. As the business got more successful, that became part of their benefit with a 6-year vesting schedule. So didn't have 401k, so instead of getting at that time 17 or 18,000 of contribution and some match, they were getting a dollar amount that was significantly more, where they can control the investments inside the plan, and they had a vesting schedule attached to it. They liked it a lot better, and it had a little bit of handcuff associated with it. We then, at the same time, built out different levels of both executive comp and benefit plans, and one of them is called a performance unit plan, or a PUP. You'll see it on there, and phantom stock. Has been an extraordinary plan. You've seen just in the last few years how much growth is actually going on there. They're about to merge with another company, and I see this actually probably being a $2 or $3 billion sale when it's all said and done. They are a very important part of our family office platform today. We reduced their insurance costs by bringing in new insurance advisors that were helpful, and this is important, if you understand the captive insurance company space, which is where you really create your own insurance company. And again, this is a discussion topic of at least an hour, so I'm going to give you just a really tight kind of idea around this. Instead of paying for insurance, letting the insurance company profit from your management of that opportunity, if you create your own insurance company, if you're profitable, you're profiting it yourself. If you plan it right, it's a very interesting platform. The premiums are deductible. There's a lot of benefit to it, and the right brokers in the world know that they get their insurance commission reduced by having a captive because they're paying less premium. But then there's management fees and things that make it if they want to keep a client forever, they're going to do what's best for their client. This is a very important space. One I've got 30 years experience in, and I think it's something that you would, if it's suitable and it makes sense, it's an amazing space. We brought in the expertise of our experts in the R&D credit side of things, as well as there was some other credits that came along as well. We brought in a new team of professionals, including legal, tax, insurance broker, captive, CPA, executive comp firm, cost seg specialist, and a few other groups as well. We actually brought in just recently supply chain service for them as well. So those were the kind of things that happened on the corporate side. On the individual side, once all that was completed, there was still profit that flowed through to the two owners. Okay, so one of the things we did was we had the patriarch of the company did go move to a non-tax state. It was Nevada initially, now it's Florida. We maximized profit sharing contributions for both the two founders, for the founder and the investor. We did use cost segregation on a building that was owned by them. We invested in conservation easements, oil and gas, and made a contribution to Seth's favorite charity. Next slide. So there'll be a slide that'll summarize this, but let me just kind of walk you through how it starts. I think this is the key to this. Started with $10 million of profit. For those who are counting, 70, that would mean, excuse me, that would mean $7 million of profit to Seth and $7 million of profit to Seth and $3 million of profit to the guy's name is Clay. So we'll put them, we'll have them just be thinking about them, but we're combining it for corporate reasons first. So the company had 10 million of profit. Okay, that leaves. So if you look at the $10 million, we allocated. Let's see. Oh, this didn't flow through on that piece. Oh, I'm sorry. Prior year's numbers. My apologies. So prior numbers, we started with 10 million. There were none of the things we talked about were in place, and had a $5 million tax bill between the two of them. It was a little more than that, but that's about where it played out. We look at the new world that we created for them on the 10 million. The first thing we did was we created a retirement plan, profit sharing plan, and some compensation, some non-qualified plans and all. We took that entire amount, that was $1.25 million of deductions the company had not had before that flowed through. So that takes them down to 8.75. Then we had $2 million in captive contributions for their insurance company, took them down another level. Then we also got $375,000 in R&D credits they never knew they could get. We actually carried back 3 years. And so we got them over $1 million of actual R&D credits in doing so, which brought the corporate profit down to approximately $6 million. Okay, so in doing so, and then on the individual side, now we'll start talking through the individual side of things. Now he's got $6 million of flow through to the two of them, which again would be 4.2 and such, but just we'll break it down here a little bit later. $6 million gets brought down to the two owners. We for them did the profit sharing of 55,000 each. There were 750 more for Seth because he had an apartment complex that we were able to do some more cost seg on. That leaves 5.2 million before it's distributed. Then 3.2 million was allocated to. So if you look at the deductions that came across, we invested about $500,000 into conservation easement, and it created a $2.6 million tax deduction. We invested $500,000 into an oil and gas investment at a 98% tax deduction. And then he went ahead and made a charitable contribution to his former college for $100,000. So in essence, when it was all said and done, it left $2 million. We got the $6 million down to 2. So it's another $4 million of deductions. On the $2 million, since Seth is a 70% owner, 1.4 flows to him. Because he's now in Nevada, he paid a 40% tax back then. That's a $560,000 tax. So his total taxes were $560,000 on what was a $7 million taxable income, and would have, and you can imagine at 50%, that's $3.5 million versus $560,000 of taxes. And for the CEO, we just did the math on the right-hand side to show that we got his what would have been, again, $3 million of taxable income. We got him down to 600,000 times a 35% bracket. Got down to $210,000 in taxes. And if we had $3 million times a 7% bracket, that would be $210,000. So it plays really close to a 7% net overall tax bracket. Can you go to the next slide, please? So just putting them side by side, looking at a scorecard, just completely on tax only, and a lot more went into this than tax. You can imagine, to get to where we were, this was not something that happened overnight. It did happen within 6 months. And I'll say this: if you look at the numbers, 10 million net 5, 10 million net 9,230,000. It's pretty meaningful. And if just real quickly, if you don't mind going back to that first slide of one of those first slides of the 5 most important things to do in COVID times, just to kind of carry back here. Keep going, 2 more. 1 more, I think, or maybe 3. This one. So if you look at these 5 recurring business expenses, and all 5 of them being extremely meaningful, show me any of the 5 outside of taxation, you could have a 90% impact in the first year or 6 months. Right. So the thing is, you can't really control time, labor. Some of the life cycle, technology, and facilities. Some of the facilities you can control, but most of those you can't control quite as much. Or your sales, the taxation's one you guys can actually control. You have the right team around you. So sorry I made you go all the way back there, but I thought it might be a good exercise to go through.
It illustrates the point brilliantly.
Okay, next page, please. Next slide, please. So this is one of our. This is actually a funny story, and I'm not a guy who wants to go around name dropping a whole lot, but this is a gentleman that I actually got to play basketball on the weekends for 2 years. One of the greatest athletes of all time. Kids went to my kid's school, but boy, did he say it right. When skates where the puck is going to be, not where it has been. You think about everything that we talk about in proper planning, and people that understand sports, understand business, know that we've got to get in front of something and see where it's going and get there first. And there's a lot to be said about that. Next slide, please. Keith, you're going to take this one?
Yeah, okay. And so for those listening in, we've had a couple of questions that I've answered, but you can reach out on chat, or you can come off of mute and ask Brett a question here in a moment. But so what's the next action that you can take as a business owner? And there's 2 paths you can take. One is based on the compelling nature of what you've just seen. You can go right to what we call the fast path and reach out and retain Brett's team for a $25,000 retainer. They will do a deep analysis and come back with recommendations from all of the partners at the table that Brett has referred to throughout the presentation. And often that will give you a handsome return on that investment of $25,000. And then if you want a lighter touch, it's what we call a quick view. And that is where we have one of our coaches work with you as a business owner to fill out a detailed business information sheet that goes over to Brett's team for really a high-level overview more than an in-depth analysis. And then we schedule a 1-hour call with you and Brett's team with your coach. And there's a $1,000 administrative fee just to execute on that. Brett, anything you want to add to either of these? Just any further clarification?
Just the only thing I'd share is I've never been engaged at any point in my career where somebody has seen there's an expense to have us involved. I would say that if you see what we're doing, and I know it holds very true at Gravitas as well. If you see it as an expense, we're probably already on the wrong page together. If you see it as an investment in what goes on, we have historically more than 10, 20, 30 times this investment. There's never been a time we haven't done that. We would, during our diagnostic and our chat, if we don't see the potential to have a significant impact, we wouldn't even start it.
Okay, let's see. Any questions? Anybody want to come off of mute and ask Brett questions? We have time for a few questions. It's a fairly quiet group on a Friday afternoon on a summer day is, I think, part of what's going on here. Let's see, Brett, I'm just kind of looking over some things that I was thinking about. You addressed international, which I appreciate because we have an international audience today as well as that we'll send this to. And Brett, maybe talk a little bit about acquisition strategy. You touched that on the very top. I don't know if you have an example to share or maybe a little bit more color commentary on why this year is a good year for acquisition strategy.
Thanks. Yeah, I mean, some of the biggest transactions we've ever had have had a year like this that started it. So we have a company that had been heavily involved. I think at the time they had 19 Verizon stores. The year before they started having some challenges, they had a $7 million EBITDA on those stores. They all of a sudden ended up 2 years after that. The 7 year was their top year. All of a sudden something had happened at that time, and it wasn't anything like COVID. It was just some internal things that had happened. They went from a $7 million profit, and in and around that space, there were some things that happened in the telecommunications space that impacted this, but a lot of it had to do with some changing of the way telecom was working, and some of the things they had to change up. Some of it was technology spend. There was a bunch of things happening, and at that time we saw what happened. And this is actually, for those who know STS, this was a co-venture with Rob Follows on this positioning. We went from going in from a $3 or $4 million loss that 1 year to acquiring, when it was all said and done, we ended up with 106 or 107 Verizon stores. And the first bite of the apple was about a $500 million sale. Had a 30% carry. That second bite of the apple was even more than the first $500 million position. Went out, took the capital, did a few other things, weren't planning to get back in the business, and now have a business worth over $1 billion today. None of that would have happened had they not got aggressive. And by the way, when they did all that acquisition, not one penny out of pocket. It was all done through maneuvering and management through a roll-up strategy. And so it's a big scenario. We are sharing a relationship right now with Gravitas, with Ron Huntington, with a company in the medical space that we are looking at some of those acquisitions as we speak right now. They've actually got through this well, but we think we can get to our goals a lot faster by doing those acquisitions. So I think there's an opportunity right now that if the firms are well capitalized and have a good game plan in place and great leadership, that it is a real opportunity. We're seeing time and time again right now, people looking for those opportunities as we speak.
Brett, one final question. Think in terms of those listening in that have family businesses and the generation that either founded the business or that has been running the business for the last 20 years have done really, really well. And this year is not as good of a year, and they have the next generation they've been mentoring and bringing up in the business. Talk a little bit about the value or the principles in succession, accelerating succession planning, or reevaluating that.
Yeah, it's great comment. We have a company right now that we represent that we're going through that succession plan right now. We've moved about 50% of the company from mom and dad. This happens to be a 90-year-old family business, so it's been around for a long time. Big market share in their space. Dad still wants to come in, still wants to play a role, but when we say the boys, these boys are in their late 40s. But they've taken the company from about 50 million of revenue to about 250 million of revenue in the last 8 years. And it's time for them to do the sale, and Dad's kind of sitting on his hands a bit. Mom's not really involved with it. And because of this, we think we can get the valuation down to 1/3 of where it was when we started doing the planning around this. And we'll move her very quickly. The company's very well capitalized, so that's not the issue. But the issue is we're going to save around $30 million of estate tax just by readjusting the valuation. And we're also not going to require any real debt in place in order to get it done, which there was going to be some other factors. They also the parents had just bought second to die insurance policies to pay some of the tax due, and they're spending about $1.3 million a year on those insurances that we can now stop. So not only did they save dollars, and they're saving dollars on that valuation and estate tax, but really meaningful after-tax dollars, $1.3 million a year is $2.6 million earnings for profit that just got put back in the company. So yeah, the timing of this is really good.
Okay. And Brett, one final question before we wrap up our time today. One thing you taught me last year as our partnership, we're building our partnership in 2019, is tax planning. As you get near the end of the year, your schedule and a lot of the partners get really, really busy. So I want to create a little bit of a sense of urgency, not just to wait too long to lean into these strategies. And so maybe talk about that a little bit. We're halfway through the year. Some of the things that you've laid out here take time to put in place, as well as your alliance. They're pretty busy people because they're very, very successful. Comment on that a little bit on timing, Brett.
That's great. And Keith, I know with the timing of this call, we pushed up a little because of this comment, right? in our discussions based on last year. So I think you're right on. I think for me, tax planning starts January 1st this year. For this year, for the majority of people that have had planning all their life, they're getting in January and February. They're getting their tax packets, hoping to get it done by April 15th, and and they're reacting to what happened versus being proactive and getting in front of it. The amount of education to get this at those levels and the right team. We always try to work with the existing team, but many times, again, they don't have some of the background here, so we have to bring in some of the partners that are used to doing this. October, November, the majority of the best things we have are probably sold out already. So all these have a limited supply. So it does become extremely challenging. We get people frustrated. We try to tell people when we first meet them in the beginning of the year that starting sooner is better, because we don't want to have a bad discussion come October, November that things have happened. We have in our family office business over $3 billion of sales this year already. And so a lot of the projects that are out there get fulfilled, get overtaken fast, as well as the better opportunity zone projects. The deferred compensation and retirement plans go crazy at the end of the year. So I always tell people, try to get those done in mid-year, so you don't have to be in the noise, because every single executive deferred comp plan has to be, you have to go through the whole process and enrollment at the end of the year. So November, December is all focused on enrollments. If your plan's not set up, there's nothing to enroll. So I think this is really important. And if we are looking at a tough year this year, and the carry back, the sooner you go, the sooner you get capital back in your pocket. So big checks coming to a lot of our relationships based on carry back right now.
Okay, good. Well, Brett, thank you again for joining us today. And as Brett mentioned earlier, this is a series of 3 or more conversations with Brett. With that, if you're interested in reaching out, just reach out to info@gravitasimpact.com. We'll follow up and we'll get the ball rolling on one of these 2 paths. Brett, thank you again for joining us, and everyone, have a great weekend.
Bye all.